In today's rapidly evolving real estate market, individuals and families stand at pivotal crossroads, faced with the decision to rent or to buy. This choice is complicated by the actions of hedge funds and large corporations, which, despite a public facade of caution due to affordability issues, are aggressively expanding their real estate portfolios. Most recently and notably, former Goldman Sachs partner Don Mullen and the alternative investment group Pretium has invested over $2.5 billion in purpose-built rental homes, amassing a collection of 7,500 properties across the U.S. Blackstone's acquisition of Tricon Residential and Pretium's deal with D.R. Horton signal a clear bet on the enduring value of real estate. But yet, on a day-to-day basis, we hear about the pending real estate crash. So why is the smart money actually running into real estate? For many, the immediate allure of renting is underscored by the current state of rental rates and the influx of apartment supply, thanks in part to the previously lower interest rates. Recently, we have seen real-time rental rates low as 2% year-over-year increase. Now, that's still rising, but not nearly as what it was. With over 439,000 units introduced in 2023 and an additional 672,000 on the horizon for 2024, there will be downward pressure on rental rates. The market seems to sway towards renting as a more financially viable option. However, this influx is only temporary. When rates were low, we saw huge amounts of new multifamily permits being issued. The cost of capital has skyrocketed and the permits have slowed, so the newly finished supply will be short-lived along with the underlying scarcity of affordable homes for purchase, a condition only being exacerbated by hedge fund strategic acquisitions. There is some pressure on the federal level to keep Wall Street off Main Street, but truthfully, I don't see this going anywhere. In fact, I did a video about this a couple weeks ago. If you'd like to be notified when videos come out about the current events in the real estate market, do me a favor and subscribe. I appreciate you watching, and don't be afraid to comment below about other. To get a fair comparison, you need to take into consideration so much more on the buying side. On the rent side, yes, it's the amount of money you will pay your landlord each month for as long as you're there, and probably some renter's insurance you'll take out. You'll divide those two by 12 to get your monthly payment for your total output in rent. When you're buying, you need to consider the cost of capital, aka the P&I of your mortgage payment, the homeowner's insurance, the taxes, maintenance, repairs. One of the costs that gets missed most time is comparing the opportunity costs. Well, what is that? Let's just say, for example, you buy a house for $400,000 and you put 20% down. You need to consider what you could have done with that $80,000. The standard benchmark used to figure this number is taking 7%, which is roughly that this depends on the region, the city, or even the neighborhood, but let's use a lifetime average national return of 2%. That means you could have invested that $80K and made 5% on that money. Now, I'll be doing a video on this to further explain, so please hit the notification button after you subscribe so you don't miss out on this upcoming video. But I wanted to make certain everybody has, at the very least, a basic understanding that it's not just payment-to-payment consideration. This is a short-term thinking in the works. The long-term benefits of homeownership cannot be overstated. Beyond the forced savings and potential for regional appreciation far exceeding 2%, owning a home offers stability and a hedge against inflation. Not to mention, we, as everyday Americans, do not do a great job putting money away and letting it work the way it's supposed to, letting it grow at the 5 to 7% and actually increase in value. The narrative that renting is invariably the smarter financial choice fails to account for the profound personal and economic gains of homeownership. The intangible benefits of homeownership are huge. They just are. And the fact is that you're not buying an investment, you're buying a home. Of course, I want you to make phenomenal decisions based on accurate numbers and look at it as an investment, but the home is more than that. So I'll just leave it at that. I'm not going to get into any more than that. Now, Let's focus on move-up buyers or work-from-home families. I'm seeing it firsthand with many of the transactions that I'm closing right now. You have turned a guest room into an office. That surprise addition to the family now has you considering what you're going to do. Either bunk up the kids, start commuting to work, if that's even an option right now, build an addition, or take out equity that you have benefited from and use that as a down payment on your next home. You have built a huge amount of equity over the last several years, and you now roll that into your next purchase, which will keep your payments similar to what you're paying now. I get it. Giving up that interest rate is tough, but this is a restructure of your debt, living situation, and maybe even your community. This move may allow you to get into the school district that you want to be in. It may put you into the neighborhood you've always wanted to live in. Additionally, the chances are you're buying a larger home with more potential to use a mortgage to leverage the purchase of a larger asset that gets a larger nominal return. This asset of equity has built up and has afforded you options, and options in itself is an asset. For the mom and pop investors, the market presents unique challenges and opportunities too. The focus should be on properties that promise positive cash flow rather than speculative appreciation. If you're looking to buy for appreciation, you're flipping, you're not investing. Obviously, the lower the cost of the home, the better the cash flow. And we all want that compounding return of cash on cash return, appreciation, and amortization. But cash flow should be your number one decision maker. In a landscape increasingly dominated by corporate landlords, savvy individual investors can still find valuable opportunities by adhering to principles of cash flow and long-term growth. I've said it before and I'll repeat it here. Real estate is not a get-rich-quick game. If that's what you're looking for, you're on the wrong channel. As hedge funds and billionaires quietly fortify their real estate holdings, the message to potential home buyers and small-scale investors is clear. The time to act is now. Beyond the rhetoric of unaffordability and market crashes lies the undeniable truth that real estate remains a cornerstone of wealth building and financial security. Armed with knowledge and a discerning eye towards the market's future, individuals can navigate the complexity of today's real estate environment with confidence, making informed decisions that align with their financial goals and aspirations. That's all for today. Listen, I appreciate you watching. If you have any questions, like I said in the video, do not hesitate to reach out. Please comment. I'm happy to answer any questions, whether you think I'm full of it, whether you want some additional knowledge, you want some additional resources. I've been doing this a long time, and I'm happy to share my knowledge with you. And if there's anything I can do to help, please don't hesitate to reach out. My name is Darren Hunter, and that was another guaranteed video. We'll see you on the next one. Take care.